There is no trend because buyers and sellers are balanced. A range forms because both sides have limits. Buyers are willing to buy, but only at lower prices. Sellers are willing to sell, but only at higher prices. Neither side has enough strength or conviction to break the other. This creates equilibrium. That's why ranges are dangerous. Breakouts often fail. Traders enter too early. The market punishes impatience. So far, we've established two things. A trending market moves in two phases, an impulsive move followed by a retracement. In an uptrend, when price breaks a resistance level, that level often becomes support and helps us identify where the next retracement may end. But this raises a critical question. How do you know exactly when the retracement is over and the next impulsive move is about to begin? Support and resistance give you the area, but they don't give you the timing. That's where the third concept comes in. Candlestick patterns. Candlestick patterns are what allow you to confirm that buyers or sellers are stepping back in. In an uptrend, price pulls back into a support area. You wait for bullish candlestick patterns that show rejection of lower prices. That confirmation tells you the retracement is likely ending. This is the moment when sellers lose control, buyers step back in, and a new impulsive move can begin. In other words, support and resistance show you where. Candlestick patterns show you when. This combination is what keeps you from entering too early and from chasing the move too late. You don't need dozens of candlestick patterns to trade well. You only need to understand a few powerful ones, such as the bullish pin bar. A bullish pin bar has three key characteristics: a long lower wick, a small body near the top. This tells you that sellers pushed price lower, but buyers stepped in and rejected those lower prices before the close. When this pattern forms at a support level, it often signals that buyers are returning. A bearish pin bar has a long upper wick, a small body near the bottom. This shows that buyers tried to push price higher, but sellers rejected higher prices. When it appears at resistance, it often signals renewed selling pressure. A bullish engulfing candle occurs when a bullish candle fully engulfs the previous bearish candle. This tells you that buyers didn't just step in, they overpowered sellers. At support or after a pullback, it often marks the start of a new impulsive move upward. A bearish engulfing candle occurs when a bearish candle fully engulfs the previous bullish candle. This shows a clear shift from buying to selling. At resistance or after a retracement, it often confirms the start of a new impulsive move downward. You don't need to be an expert to trade the market. Every time you open a chart, your first job is only to answer one question. Is the market trending up, trending down, or ranging? Once you know this, everything else becomes logical. If the market is trending up, you already know how it moves. An impulsive move, followed by a retracement. So instead of chasing price, you prepare. Here's the process. Identify the uptrend. Draw your resistance levels. Wait for resistance to break and turn into support. Let price pull back into that support area. Now comes the confirmation. When price reaches support and forms one of the candlestick patterns we covered, in this example a bullish engulfing candle, that's your signal. It tells you the retracement is likely over. Buyers are back in control. A new impulsive move may begin. That's when you enter. In a range, the approach is different. Draw support and resistance. Ignore the middle of the range. Wait for price to reach one of the boundaries. So far, you have market condition, key levels, candlestick confirmation. But there's one final concept that explains why the market often moves this way. That brings us to the fourth concept, liquidity sweeps. A liquidity sweep happens when the market temporarily moves beyond a key level to trigger stop losses and pending orders, and then reverses back in the opposite direction. Now let's put everything together and use the four trading concepts: market phase, support and resistance, candlestick patterns, liquidity sweeps. When you open the chart, the first thing you notice is price is making higher highs and higher lows. This tells you the market is in an uptrend. That already gives you an important rule. You are only interested in buying, not selling. In this uptrend, price moves in cycles. A strong impulsive move upward, followed by a retracement. You do not enter during the impulsive move. You wait for the retracement, because that's where low-risk entries are created. During the impulsive move, price breaks above a previous resistance level. Once that resistance is broken, it becomes potential support. This level is now important because it helps you identify where the retracement may end. Price pulls back from the highs and starts moving down toward the broken resistance, now acting as support. At this stage, many traders panic, others enter too early. You do nothing yet, you wait. As price approaches the support level, something important happens. Price pushes slightly below support. Previous buyers get stopped out. Late sellers think the trend is reversing. This is the liquidity sweep. The market briefly moves lower, not to reverse, but to trigger stop losses, collect liquidity, prepare for the next real move. This is where most traders get trapped. After the liquidity sweep, price quickly moves back above support. A bullish pin bar candlestick pattern forms. This candle tells you sellers failed to continue lower. Buyers stepped in aggressively. The retracement is likely over. Now you have confirmation. At this point, all four concepts align. Uptrend, pullback into support, liquidity sweep, bullish candlestick pattern. This is where professional traders enter, not at the top, not in the middle, but after weak hands are removed. Let's take this trade setup. We place the entry at the close of the pin bar, the stop loss below the wick, and the target at twice the risk. Look at what happens next. Price reaches the target. This is not a holy grail.